Hello, this is Joseph Gillette with Venture Capital Cross. Today's video is going to be about public versus private markets and regulation in regards to public versus private markets. So first we want to discuss private markets regulation. So private markets are regulated, but not in the same way that public markets are. So all markets are regulated. So saying that something is unregulated is really a misstatement. All markets are regulated. Anytime you use a banking transaction or a currency, all US dollar transactions are regulated by the Treasury and the Comptroller for Currencies, and basically the Fed, even though it's not regulated in the same way that public stocks are, it nonetheless is. So private markets are regulated in the sense that if you want to raise money from for your company from investors, you're probably going to do that under a Reg D private placement. Now, a Reg D private placement does not need to be managed by a broker-dealer, but it usually is. Most private investments are Reg D private placements, but you also have Reg CF, Reg A, Reg A+. You have a lot of different types of ways that you can register an offering. Now, you do not need, it's not required to register your Reg D offering. So, for example, if you take money from friends and family, you have your investors are your dad, your cousin, your uncle, and your neighbor. You probably don't need to file, but you can, and many people choose to file even if they don't need to, because the Reg D is really not much of a filing. It's not something that's accepted or checked. It's just a database of filings. That's a data collection service more than anything. And if something does go wrong, they're going to look back and see if you filed it or not. Reg D doesn't require you to have audited financials. It doesn't require you to have really financials at all, just that you're raising money, and it asks you some questions like who's getting paid on the offering and so on and so forth. So when you're raising money, you typically file the Reg D. Most private companies do that, and their lawyers do it, and sometimes they do it with broker-dealers and investment banks. So public markets are a lot more heavily regulated, but the difference here is that in private markets, it's a choice. So the majority of private markets transactions will use a broker-dealer for the same reasons you might use a real estate agent. Do you need a real estate agent to sell your house? No, you don't. But there's a lot of paperwork involved, and there's a trust factor that you want to make sure that the buyer or the seller is legitimate. You want to use a trust company. You want to use a lawyer for the closing, and a real estate agent is going to organize all this for you. It's like herding wild cats. You can do it yourself, but do you really want to? Also, the agent may identify a buyer for you or a seller, if depending on which side of the market you're on. So there's a service element involved, but the markets are regulated. So do you need a broker-dealer to transact in private markets? Absolutely not. But you're going to need to know how to notice the company, what steps are involved in settlement, what is a ROFR, where are the shares custodied, and the answer is you can't custody private shares. It's like a real estate transaction. So the broker-dealer or other trusted third party is going to be managing all that for you. So it's a service thing. So as far as watching out for investors, the SEC has taken a very good look at private markets, specifically what they call pre-IPO SPV shops. And I don't like the term pre-IPO because that implies that an IPO is imminent. So for example, Klarna filed recently confidentially for an IPO. Now Klarna didn't set a date, but you could say that Klarna is pre-IPO because they've said they're going to IPO. They filed confidentially. It's in the news. But a company like Databricks or Epic Games, they've never announced an IPO. They're not talking about it. You can't really say those companies are pre-IPO. Epic Games may stay private forever. There's a company called Bechtel in California, which is one of the largest private contractors in the world, and it's a 150-year-old company or so, and it's always been private, and it probably always will be private. So there's no reason companies have to go IPO. IPO is not the default go-to exit that you have to do it. It's the most likely, so most private companies are going to want an IPO, but for a number of reasons that may not happen, so they may stay private forever. So in another video, we compare the differences between private and public companies as far as the issuer is concerned, and there's some benefits and risks associated to each. There's not one solution that fits all. It's always a case-by-case basis. But the point is, in private markets often feel a bit awkward because almost everyone is familiar with investing in stocks. I think there's 55 or 60 million stock accounts in the United States, and for a population of 380 million, if you include the illegals, it's probably over 400, but something close to 400 million people. 55 million, 60 million is still a lot of accounts. It's still a good percentage of the population, and that's not counting for children and the elderly. So that's a pretty good percent of the population has a stock account, and I'm willing to guess that almost everyone knows what a stock is. So that's not the case in private markets. So a lot of times when people invest in private markets, they're a little concerned and they ask questions like, is it regulated and stuff like that. And that's why investors do have to be accredited for private markets. So that's one requirement. All investors have to be accredited. Now, if you want to buy or sell a forward contract, which is a derivative, you have to be an ECP. And an ECP is going to be a much higher bar. It's 10 million liquid cash. And there's some other ways to qualify, but ECP is much higher than an accredited investor. It's like here, and accredited is like down here. That's for selling or buying forward contracts. And what's unusual is you have to be an ECP whether you're the buyer or the seller of a forward contract. A forward contract is basically when the seller receives money today but will deliver securities at a day in the future, such as the IPO, and this is done when there are transfer restrictions. So other things to know about private markets investing compared to public markets and regulation is that custody. You can't custody your private shares at your public brokerage account. Now, it makes sense if you're investing in private companies to have a public brokerage account. And some of the reasons are, for example, if your company goes IPO, then you need a place to deposit the shares. Similar companies, you can't short sell private markets companies, but you might be able to short sell a competitor for industry risk mitigation. So for example, if you're in the aerospace industry, SpaceX is private, but there are tons of public companies doing similar things like Boeing, Lockheed Martin, and other companies. Raytheon, or whatever it's called now, RTN. You might short the public company as a means to hedge the private company. And I'm not saying that always works. In the case of Boeing and SpaceX, that wouldn't be a very good hedge because they're kind of competitors and one is taking the other's business. But in many cases, like if you're in, let's say, fintech or a very kind of specific sector like Eat Just and Impossible Foods versus Beyond Meat, which is public, that might be a good comparison, because if people stop eating this artificial meat because of health concerns, Impossible Foods is going to suffer the same like Beyond Meats is going to suffer. So you could short Beyond Meats, and if you're long Impossible Foods, to give yourself a little hedging there if you wanted to. I'm not recommending that. I'm just saying that if you have a public brokerage account, that's going to be an option. So it's highly recommended that investors in private markets get public brokerage accounts, but it's absolutely not necessary. And there are some other differences, but we're getting kind of long in this video, so we're going to break now, and we hope to see you in other videos. And also check our Udemy course on venture capital. We're adding all these videos into that course, so it's very robust. It has lots of training, and we also have free learning materials on vccross.com/learn. Thank you and have a great day.